Right now, though, very pleased to welcome back to the show Bob Hoye, Institutional Advisors. This is a guy who so clearly called the credit tsunami that was about to absolutely wash over the world in 2008 and the accompanying ramifications for that. And as I said right at the top of the show, this is a business where getting it right is what counts. Not like politics where the rhetoric and the photo ops do. No, this is the real world here. Well, Bob joins me on the line right now, and I'm so pleased he could find time because I think this is an incredibly key time right now. Global economy, which impacts, of course, right through Canada. Bob, thank you for finding time.
Hi, Mike. Good to be with you.
There's so much to start with here, so let me just say this. We had the Federal Reserve move this week, so let's just talk about that for a moment. It was widely anticipated, and I was saying earlier to Michael Levy, I was surprised in the sort of aftermath. I mean, usually markets react in advance.
Well, the stock market you're talking about here is that it isn't too healthy at the moment. And so there is a school of people out there that no matter what the Fed does, it's celebrated. So they pop the stock market up, and then it's on trend for down. The other thing about the senior central bank is that it has a tendency in times of great excitement like recent or 2007 or 1929, they follow the market changes in interest rates. The market rates of interest, they will change as a boom goes along and then increase. And then typically the Federal Reserve follows. So all of the people who focus on this great change in interest rates, it's absolutely meaningless.
Yeah.
Now, here's what you've got, is that long-dated treasuries have been rising since February. You've had junk bonds, low-grade stuff. Interest rates in June of 2014 were at 8% for CCC-rated junk. It's now at 18%. And that's been a year and a half's increase. So that they were stalling out for so long was the unusual thing. They should have raised them quite a bit ago. But they're not makers of markets. They're followers of markets, and it has always been that way. So a lot of the spokesmen here now are wondering, how many Fed rate increases there will be.
I think that's the big question for me is, I'll come back to the junk bonds, though, because we just skipped over that for a second. I'm coming back to that, but right now, I think isn't that the big question is this the beginning of several, or are we going to get back to the sort of historical averages? What do you think?
Well, the junk bond rates are going to continue up. There's the Federal Reserve has been able to push short rates for a while, but they can't push the yield curve, which is the difference between long rates and short rates. That the Mr. Market does. Then the other one is credit spreads, which is the difference in quality between high-grade bonds, like treasuries, and low-grade bonds, like junk. And when the public is in a positive move, that spread will narrow on a business expansion, and that those spreads stop narrowing in June 2014. And so the history of central banking is that they have no influence on credit spreads or the yield curve when it is ready to change. And it's been changing here for some time now. And just take a look back in the contraction of 2008, 2009, that CCC-rated junk bond got up to 45%.
Let me just go back on that for a sec, make sure people are with us on that, Bob. So what you're saying is that when you get into an expansion, let's say we're getting 2% on a treasury bill. The government, has to borrow at 2%. But, because it's an expansion, the lower grade stuff gets toward that. It might be 5, and it maybe should be 15, but it gets down to 5. People searching for yield as we've been experiencing. But now, as you're saying, that spread's increasing again. People are starting to look at quality, the lack of quality. And that's quite a stat. That spread used to be 45%.
Well, that was the interest rate at 45%.
That was the interest rate at 45, yeah.
And so the point to be made, Mike, is that the central bankers have no power to prevent widening of credit spreads when it's time to widen. It's the markets that drive that. So, yeah, if one wants to talk about the administered rates by the central bank, yeah, they're going to go up. Not because the Federal Reserve or the Bank of Canada has decided some genius means that they're going to raise rates. No, all they're going to do is follow the rise in market rates of interest that is already going on. And one of the things about the credit market is when you change trend, either for the good, like coming out of 2009, which then everything turned positive, the curve started to flatten, and the spread started to narrow because everybody confidence was coming back in the system. There was nothing anybody could do to prevent the goodness from prevailing. Mm-hmm. And the same then, it reached a crescendo, a maximum, whatever you want to call it, in June a year ago. And now it's going the other way. And there's nothing that any policymaker can do to change that. Now, the other thing is to go back is on the spread market, on high yield stuff, is that there was the peak for commodities in June in 2014. Yes. Crude oil was around 107, and it came down, and then there was about, I think the market for junk bonds was about 17% of it was written by, oil petroleum companies, so then that side goes down. But then the problem when you have the price of junk bonds going down that are mainly oil patch junk bonds, then others go down as well. It's an integrated credit market. So we are now on the next great train wreck in the credit market.
Let me just hold on that for a sec, Bob, because I got to take a break, but I've got to come one more thing here because I definitely want to get back to this because I think this is a monster risk for people right now. But come back. Is Canada the same as the U.S.? I mean, are Canadian rates following suit here?
They will, yeah, the same level. Like you've got the high grades with AAA rated corporate Canadian bonds, and you've got the long dated Government of Canada bonds. They will be working with the U.S. their equivalents in the U.S. Each day, because as U.S. rates go up, so will Canadian rates go up. And the fact that the Government of Canada, the Bank of Canada, is talking about going to minus rates is an absolutely absurd event. What it is a confession that their theories about managing the economy don't work. They've got this idea that if you provide credit, it will stimulate business. But if business is not flying, then the stimulation goes into what the public chooses to put it in, which until a year ago was low-grade bonds, junk bonds. They're no longer speculating in commodities. And so it was the two financial items the public chose to mark up. And that was junk bonds and stock markets. And
well, we'll come back, Bob. Just hold on for a sec. I got to take a break, but we're going to come back on that junk bond. I'll start with a quote, and got Bob Hoye here, thank goodness. Institutional investors, this is a key thing. Have we had a sea change in the credit markets? Back with Bob Hoye in just a couple of minutes across the Course Network. Coming up, I've got a shocking stat of the year and maybe a shocking quote from Time Magazine's Person of the Year, Angela Merkel. Let me start with a quote here. I've got Bob Hoye, Institutional Investors. Here's a quote from one of the big money managers, and I think this is the telling tale. He says, "It's not the return on capital, nor the return of capital, but the access to capital is what really matters now." He's talking about the lower grade bond market. Something that's the B's down to the C's. You hear those ratings, AAA, triple B, that kind of stuff. So he's talking about the lower end of that. He's worried, and there's a couple of examples. We won't bore you with them right now, but you won't even be able to access your capital. And I think you got to be clear that economic contractions happen. But the one that worries me, and we saw it in 2008, is the credit contraction, Bob, and that's what scares me about the junk bond market. I mean, I think we've had about $13 billion in defaults already in, oil companies borrowing, in the marketplace. But, these lower grade bonds are scaring me from a liquidity standpoint.
Oh, the liquidity. Well, a year ago, the big advisory firms were talking about that the liquidity had gone out of the long Treasury market. Now, here's what happened, I guess a week ago, is people at a junk bond mutual fund went to redeem their bonds, and they couldn't. They just, the fund manager said, no, they couldn't in turn sell their bonds in order to pay the people who wanted to redeem their positions. So, and then there was also some sort of a hedge fund who denied their partners the ability to redeem their stuff. So
that's the part that's really scaring me these days. Is say, they couldn't even liquidate their bonds. They had no buyers on the other side.
Yeah. And this is before the full disaster has been realized. You've only gone from 8% to 18%, and it's a long ways to 25 or 30% yield on the junk. And I'm just looking here at the spreads, which in 2007, this is the triple B spread, which is investment grade, 1.5%. In the height of the crisis, 8%. And then here at the best in 2014, 1.5%. We're now at 2.40%, and breaking above 2.42 is a breakout on this thing. So these markets are irresistible, and there is no liquidity.
Well, Victor Adair and I have been saying for ages that, and as others have, of course, but, the search for yield is going to get people into grade of investments they shouldn't be, that they're not aware of. They don't want to stay in the government bond and get 1% over 5 years or 1.5% or something, so they've gone into further out on the risk curve to get a higher rate. Those are the guys I think could be in big trouble here.
There will be. And here, this is where the government is culpable. By artificially lowering rates, they've forced ordinary, normal people to invest in things they shouldn't have touched. Yeah. And the culpability on government, it's evil. These theories that a committee at a central bank can make the economy better for everyone is absolute nonsense.
And haven't we just had a case study of that for 6 or 7 years? They haven't got the result they wanted. There isn't sort of robust economic growth. They've changed asset prices, and they've killed savers and pensions in the process.
You're right on that, but take a look at it. The intrusion over the last 25 years has increased every year, where they've got this rule, that regulation, red tape, monumental burden on the back of the ordinary businessman. So then they get a theory that if we give it this much stimulus, we'll get this much business activity. But it's not happening because all of their rules and regulations are preventing a robust business expansion. So then where does the credit go? The public chose to put it in junk bonds and in the stock market. And that has reached the maximum. On junk in June 2014, the price action was such that, we had upside exhaustions, all kinds of technical stuff that said, hey, this is the top for the junk bond price. And then, of course, through the summer months, just last summer, you had similar technical analysis on the stock market said, hey, this is perhaps a big rounding top. And then when you had the spreads widen in breaking out in July, that set up the crash in Shanghai. And then you came down, the Shanghai crashed into late August, and then tested it in September, bounced up, and now that rebound got tired, and I think it's starting to roll over. And it doesn't have anything to go underneath the stock market because commodities are so weak, Mike. The commodities weak say that the global economy is weak, and they talk about crude oil. The Saudis are pushing crude down to try and shut down the fracking production in the U.S. This is like any post-bubble deflation, where the farmers will plant grain from fence post to fence post in order to make more money because the price is weak. And here you got it going on in crude oil now where they're drilling from fence post to fence post. And the idea that the Saudis are deliberately, this is very naive. We are in a post-bubble bear market for most commodities.
Let me just very quickly, because time's short, but okay, let's talk to investors for a second. If you were going to, if you're going to buy, some sort of fixed income thing at the highest level even, what time frame do you go out? Very short, like 1 year, maybe 2 or something?
You got two things to keep in mind. You got term risk, which is price, and then you got credit risk, which is credit. So the best thing to do would be go to investment grade U.S. corporate bonds.
Mm-hmm.
Then you get a better yield than if you went to treasuries of the equivalent time. Then also the term you want to go is maybe 4 years, around 4 years.
Yeah.
So you won't get hit in term risk.
Right.
And you won't get hit in credit risk. Plus, you'll get the pick. We've been saying this since 2014. Plus, you'll get the pickup on the U.S. dollar.
Yeah.
So it's a very nice place to be. Now, also, one should always own some gold as insurance, but you don't own it to try and make money out of it. That's playing currency games. And at some point, maybe in the next few months, it would be time to invest in some gold shares because profitability is probably returning to the gold mining business. We don't expect profitability to return to the base metal mining business for some time. And the rest of the equity markets are vulnerable to, one, the credit problems, and two, the probable recession. So,
just very quickly, Bob, is there an area or a market you're saying to people, whatever you do, avoid this?
Well, we've been avoiding stuff like the resources side since the high for the crude oil in 2014. We've been avoiding the base metal side since the cyclical peak for base metals in 2011. So there's no point going near those things. And the only, as I say, on the equity side, other than some exceptional stocks in the high-tech area, which is difficult to cover, the one side that you can analyze is that in a post-bubble contraction, eventually the gold side gets very good because the price of the mining costs of your commodities fall relative to gold. Look at how far crude oil has fallen relative to gold, and crude oil represents the cost of energy. So, in any post-bubble deflation, the cost of mining go down relative to the bullion price, and then that's what then makes the gold mining companies investment grade. So
well, that's we've got to leave it at that, Bob. Sorry, the time is short. Thank you so much for finding time. Great to chat with you again. Great stuff.
Good to be with you, Mike.